Have you tried to buy a home recently? Or maybe just browsed online and had a minor heart attack looking at the prices? Yeah, you know that feeling. It's frustrating, it feels impossible, and you just want to know why. Well, today, we're going to dig into a huge part of that story, the new landlords and how corporate investors are completely reshaping the American housing market.
So let's just get right to the question that's on everybody's mind. If you can't afford a home right now, who or what is to blame for this whole mess? To figure that out, let's start with part one, trying to identify the most popular suspect in this housing crisis.
Okay, to really wrap your head around the scale of the problem, you've got to know this number, 4 million. The United States is short about 4 million housing units. That is a massive, massive deficit of places for people to live, especially when we're talking about starter homes and affordable apartments.
And in this kind of crisis, a popular culprit has definitely emerged: large-scale corporate investors. Since the pandemic started, these institutions have bought up hundreds of thousands of American homes, a lot of the time using all-cash offers that just blow regular families out of the water.
And this really shows you the core conflict, right? Just imagine a bidding war for a little 3-bedroom house. On one side, you have a family that has scraped and saved for years to get a 10% down payment. And on the other side, a Wall Street LLC offering all cash, no questions asked. I mean, who do you think wins that fight? It really feels like the game is rigged from the start.
But is the story really that simple? Let's take a look at the counterargument. For a while, a lot of experts didn't really think so. The conventional wisdom from a lot of housing economists and policy analysts was that these big investors were playing, at most, a bit part in the larger crisis. And their reasoning was pretty straightforward. These deep housing supply shortages, especially in big coastal cities, are decades old. Major Wall Street investment in single-family homes, though, that's a much more recent thing, a trend that really just took off after the pandemic. So the thinking went, investors couldn't possibly be the main cause. But some new data has started to paint a much more complicated and, frankly, a much more revealing picture. So it's time to follow the money. A recent, really detailed analysis of 500 major urban counties uncovered something pretty remarkable. As it turns out, corporations now own 1 in every 11 residential properties in these areas. That is a much, much bigger footprint than a lot of people previously thought. And that ownership isn't spread out evenly, not at all. In some specific communities, corporate ownership is even more concentrated, going above 20% of all properties. So this isn't just a little sprinkle of outside investment. In some places, it's a total flood. So what's the strategy? It's often called buy low, rent high. See, these investors aren't just buying houses at random. They are pouring money into very specific kinds of communities, often in the South and the Rust Belt, where wages might be a little lower and where a large share of families just can't afford to get a mortgage. And the direct impact is spelled out perfectly by George McCarthy, who's the president of the Lincoln Institute. He says, and I'm quoting here, they're pulling all the starter homes off of the market in low-income, high-minority density neighborhoods. This isn't just about real estate. This trend is directly making the country's racial wealth and homeownership gaps even worse. So this brings us to a tale of two neighborhoods, where we can actually see the real-world consequences of this strategy right on the ground. Let's start in Cleveland, Ohio. Here, corporations own a staggering 17.5% of all residential parcels. Think about that for a second. That's nearly 1 in 5 homes owned not by a person or a local landlord, but by a large corporation. And if we zoom in on the city's predominantly Black East Side, the picture gets even clearer. In 2021, only 1 in 5 homebuyers there even took out a traditional mortgage. The rest, and you can guess many of them were investors, paid in cash. The market for starter homes there is being completely transformed. And this data from Baltimore really just shows the stark reality of this trend. In a majority Black neighborhood, only 13% of homes sold in 2022 went to people who would actually live there. Just 13%. But in a nearby majority white neighborhood, that number jumps all the way to 80%. It's a completely dramatic and unequal playing field for who even gets a shot at owning a home. So, what's the real bottom line here? What does all this data really add up to? Well, it seems we're not dealing with just one housing crisis, but at least 2 different kinds.
In those expensive coastal cities like Seattle or Boston, the crisis is still mainly driven by those decades-old supply shortages. But in the Rust Belt and southern cities like Cleveland, it's a crisis of market distortion, and it's being driven by this new flood of investor cash.
So the main takeaway here isn't that corporate investors caused the entire housing crisis across the whole country. The real, more nuanced issue is that they are strategically targeting the most vulnerable part of the market, the starter homes, in very specific communities. And the effect of this surgical strategy is profound. It's pushing thousands of Black and Latino families right off the property ladder, preventing them from building generational wealth through homeownership, and actively widening the racial wealth gap in America. Which leaves us with a really critical question for the future. As corporations turn more and more of these starter homes into rental properties, are we witnessing the end of an era? Is the starter home, that classic symbol of the American dream, is it becoming a thing of the past?